Corporate finance practice problem using Excel. Impact of bond rating change on bond price. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, calculating the price of the bond, but with a change in the bond rating. The new focus being on that change and the impact to the market rate and possibly to the value then of the bond. Note that we have gone through bond calculations, standard bond calculation, price calculations in the past, and you can take a look at a prior section where we'll do that a lot slower and in more detail. Also note that if you want to look at the present value calculations related to bonds or other present values in something other than Excel, such as the use of tables or the use of mathematical formulas, we have another section focusing in on that. Here, we're focusing in on that change for the rating. So we're imagining a situation where we have the bonds at the face amount of 1,000 issued at the AAA rating here, and then there was a rating change of the 11 to the AA3, and you can see the change in the rates related to it. So the years to maturity will be 10, and the semi-annual will be the payments of when the interest will be paid. Now, note that if we were to issue the bonds and we were trying to match up the rate on the bond to the market rate when we issue them, then we might issue them at the AAA rating at the 9%, creating the amount on the bond, the rate on the bond, to be equivalent to the market rate, so we can issue the bonds at no discount or premium, simply at the face amount, in this case, the $1,000. Now, if there was a change then in that rating, and we just issued them, let's say, or there was a change fairly recently, note that change, of course, will have an impact on the value of the bond. So if the rating goes down, there's going to be less faith in the ability to repay the bond. The risk is going to go up, in other words, for investors. And then you have to compare it to similar bonds in that rating. If it went all the way down to the AA3, then you can see there's going to be a different rate, because obviously as investors, they're trying to weigh out the risk and the reward, and the bonds that they believe are more risky, less likely to get paid off, for example, then obviously they're going to want a higher return with relation to those bonds. So what we'll do is we'll recalculate it and imagine that there was this change from a AAA or AAA to AA3 down here, and that had a change on the market rate. What would be the change on the price? So we'll do our price calculation, imagining the 9% being the calculation on the bond itself, because that's what we issued at before the change took place. Then there was a change in the rating, and then see the impact on the price of the bond. So we'll do the present value calculation of the interest payments, which will be semi-annual, and then we'll do the present value of the principal at the end of the bond of the 1,000. So this is going to start off with the present value of interest, which is going to be negative present value, shift 9. The rate is going to be the market rate, which we're now going to say is that 11%. Now that would be the yearly rate, and these are semi-annual bonds, so we're going to take that and divide it by 2. Remember that the rates that are shown, whenever you're basically looking at rates, unless it says otherwise, they're talking about yearly rates. Yearly rates are going to be something in the realm that we can talk about easily without having very small numbers. That's the convention. So if we want to apply a rate to something other than a year, we have to make sure that we do that by dividing it by 2 in this case for a 6-month time period. Number of periods, we're going to say then would be 10 if it were yearly, but it's semi-monthly, therefore times 2, there'd be 20 of them, comma, and then the payment would be the 1,000 times the rate on the bond, and we issued the bonds at the AAA rate, the 9%, and then we'll divide it by 2 because it's semi-annual. So the 1,000 times the 9%, that would be for a year. We'll take that, we'll divide it then by 2. Closing that up. There we have it. Now let's add some pennies there. So let's go to the numbers group, add a couple pennies, and then we're going to take the present value of principal, and it shouldn't say if, it should say of here. All right, so now we're going to bring this 1,000 back to the current time period. So this is going to be negative present value, shift 9. The rate now is going to be the market rate. Once again, the 11%, that would be for an entire year. We want it for 6 months or half a year, so we'll take that divided by 2. Then comma, the number of periods would be 10. That would be if it were yearly. but we're talking semi-annual, so we'll take that in times 2 for the 40 periods, comma, comma, because it's not an annuity, but present value of 1, and then we'll pick up the future value, which is that 1,000, bringing it on back, closing it up, adding a couple decimals there. We're going to go to the numbers group, add a couple decimals. Let's put a line underneath that 342.73 in the font group, calling that an underline, and that's going to be the price of bonds, which will be the sum of these two, the sum of these two, and that would be the 880. Let's add a couple pennies, go into the numbers, couple pennies there, 880 and 50 cents. So obviously, if we issued them at the 1,000 and we have this decrease in the rating of the bonds now, meaning to the markets, signaling to the markets these bonds are more risky than they once were. Therefore, in order to take them on, you would think that the market's going to want higher returns on them, and that changing the rate from here to the 11%, the 11% that the market wants now being higher than the rate on the bonds, which were issued at the 9%. Therefore, you're going to have to sell the bonds at a discount, the discount now being the 880 and 50 cents, whereas before they were selling at the 1,000, which was even to the market rate at the AAA rate when issued.